Welcome to the ISG quarterly webcast for the third quarter of 2018. My name is Howard Coleman, and I'm the Chief Investment Officer of Coldstream. And with me today is James Walsh. He's the Portfolio Manager for Kevin Fitzwilson's team. This call is scheduled to last for 30 minutes. We may go over to about 45 minutes, so please bear with us because we want to cover these important topics for you. I'm going to be starting the call, giving you a market update, and then James is going to do our special topic. And our special topic today is the leading economic indicators, what they are and why they are important in the investing world. So let me start with the market update. For those of you who listen to these webcasts regularly, you'll know that typically in the market update, we just cover what happened in the previous quarter. We're going to make a slight exception for this update, given all that has happened in October, and we want to bring you more up to date as to the current goings on in the market as opposed to just covering through September 30th. So what I'm going to talk about is what's happened prior to the third quarter, what's continued through the third quarter and to date, and what's changed both in the third quarter and since the third quarter. And finally, we're going to talk about what we're watching. At that point, I'll hand the microphone over to James, who will discuss the leading economic indicators with you. This is the chart that many of you have seen before, just with different numbers to reflect what's happening now regarding the various asset classes throughout the world that we follow. The third column, the first column, of course, gives you the name. Second column gives you the asset class. And the third column goes what happened through the third quarter. This is a column we've added for the fourth column is the column we've added for this call as to what's happened between 10/1 and 10/15, and then overall where we are year to date on 10/15. So coming into the third quarter, the outperformers in the investment world was the NASDAQ composite, which, as all of you know, was the tech index, the Russell 2000, which was the small cap index. They were the significant outperformers. The significant underperformer was emerging market equity. So in the third quarter, some things changed and some remained the same. Emerging market equity continued to be a terrible performer, and it continues to be a terrible performer through 10/15. You can see through the third quarter, it lost about 1%, and through 10/15, it lost another 7% and is down 14% year to date. Now, the NASDAQ, on the other hand, was significantly the leader coming into the third quarter. It did well in the third quarter, but as you can see, it did not do as well as the Dow. And the Dow had been a laggard until the third quarter. There was a rotation into some of the larger industrial stocks and a rotation away from tech. And as you can see, that continued through the 15th. Commodities, which has had a very difficult year, also lost money in the third quarter, but rebounded from 10/1 to 10/15 and was really the best performer. And the other important note is small cap equities, which was an outperformer, underperformed in Q3, and that underperformance significantly continued through the 15th. It is now significantly underperforming the S&P, which was not the case at the end of the second quarter. So now we're going to go through just some charts, some longer term price trends on these charts to give us a little bit of insight as to where we were and where we're going. This is the US large cap stock. The red line is the 200-day moving average. The blue line is the 50-day moving average. As you can see, large cap stocks since March of 2015 have been above its 200-day moving average. Breaking below it is not a good technical signal. We see that large cap stocks briefly broke below it after being well above it at the end of the third quarter, but it's bounced off that 200-day, and we're watching whether it continues that bounce off or whether it falls below. As you can see in the SMID index, that had a nice run as well, but it has fallen further and has fallen below its 200-day moving average. It's trying to come back up to it, but given the events of today, it may have violated that for a while. This is the NASDAQ, and as you can see, the difference between the 50-day and the 200-day was pretty wide. It violated the 200-day, but has come back, and again, we'll see if it tests it again. These are all technical indicators, and they are not by any means foolproof, but they are something that we keep an eye on as a factor that we look at. International developed, this is not a good chart. As I think you can see, it's well below its 200-day and has maintained itself below the 200-day. And this is the worst chart of them all from a technical perspective. This is a emerging market chart. As you can see, the highs, the short-term highs, keep on going lower. And that is a bad technical sign. It's well below its 200-day moving average, and its short-term highs keep on getting lower. Not a good chart. So with that in mind, let's talk about what's continued throughout the year and into 10-15. And even with the decline in the Dow and the NASDAQ, the differentiation between U.S. performance and international performance is at very, very high levels. The U.S. is significantly outperforming, especially EM and also Europe and other developed markets. This is not completely unheard of, but it is highly unusual. We are in a significant range of outperformance by the U.S. right now. The other thing of interest is that some of the junkiest investments have rallied the hardest or held up the best. This is high yield bonds, which by themselves are bonds of junky corporations that are highly indebted. And they're graded a double B, single B, triple C, with triple C and lower, of course, being the lowest quality. That's the orange line that you see. So the junkiest of the junk has outperformed just the regular junk, let's put it that way. And high yield itself has held up very well comparatively. And that has continued throughout the year. Of course, this is just a headline to represent what's going on, but we all know that the tariff rhetoric has also continued, and that is certainly playing a role in the difficulties that emerging market, especially China-related stocks are having. On the plus side, the thing that has continued this year is corporate profitability. And it really has been a wonderful year for corporate profits, in part due to tax reform, but not completely due to tax reform. This chart shows the grayish box part of the bar, the grayish part of the bar is margin, the green is revenue, and the blue is share count. And if you can see the little box for the second quarter of 2018, companies have reported earnings and 26.7% increase in earnings. And the average for the last 17 years has been 7%. The really good news about this is there's been a 10% plus revenue increase, which really shows growth. Margin increase is good, but also oftentimes that can be related to cost cutting. And you can't really cut your way to prosperity. You need growth, and we have that growth. There's been a lot of concern about tax reform spurring buybacks, and it has, and that has certainly helped the market. But in terms of earnings per share growth, it really has not been that significant. Certainly higher than historical averages, as you can see, which is about 2%. But in the second quarter of 2018, it was 1.2%. Third quarter earnings are just coming in, and I will talk about that a little bit later. The final thing that's not changed is the economy is strong. Unemployment rate is continuing to fall, and James is going to cover a lot more of this in his discussion of LEI's leading economic indicators, so I'm not going to go into detail on this. So what has changed? The concept of market breadth has changed. That is the number of stocks moving up versus the number of stocks moving down. And the blue line, the dark blue line, represents the percentage of S&P stocks above its 200-day moving average, and the light blue line represents the S&P index. And as we can see, breadth is not great. You have a higher percentage of stocks moving down than you did previously. In other words, below the 200-day moving average. The other thing that we've seen is a small cap reversal, and we've discussed this before. And the red line is the small cap index, and the black line is the large cap index. And we can see, for example, in June, if you look at the red line, was significantly outperformed. That reversed in September. And while one never precisely knows the reasons for a reversal, there's a couple indications. Once, that was the exact day that Canada signed up where it reversed on NAFTA. So there is a theory that small caps outperformed because they had less exposure to trade wars, and the new NAFTA agreement assuaged those concerns. The other theory, they're not mutually exclusive, is that small cap firms are generally more indebted, and as interest rates have risen, that potentially is seen as more of a headwind in small caps. The other significant thing that has changed is this growth versus value concept. Now, the white line represents growth and the orange line represents value. And as you can see, growth has dramatically outperformed value. James, who follows individual stocks because he runs a mutual fund more than I did, pointed out to me this morning that this divergence has not been this significant since the late 90s in the tech bubble. However, when the market fell in early October, that switched temporarily and value significantly outperformed growth. Growth fell a lot harder than value. Now, since that time, since the 11th, it's really vacillated back and forth almost on a daily basis, whether growth outperforms value or not. But the persistent outperformance of growth over value has at least temporarily subsided. What else has changed, of course, is interest rates. And I think we're all aware that the Fed is begun tightening and is in a tightening cycle. This shows where rates were 90 days ago versus where they are now. The blue line being 90 days ago, the red line now, and we can see across the curve, rates have increased. And actually, the curve has steepened a little bit. The difference between 5 and 30-year bonds has steepened as the 30-year has risen. And this is something that is somewhat important because an inverted yield curve is often a sign of a precursor to a recession. This chart shows the 10-year yield going back to 2010, and you can see that it has risen recently, and we have not been at these levels since the middle of 2011. And I think, as we're all aware, especially in the Seattle area, given the fact that the housing market is less frantic, I would say, I'd be a little cautious of saying that it's slowing, but it's certainly less frantic, as we know, and it's a more normal market, and this is a significant reason why interest rates have risen significantly recently. And volatility has increased. And part of that increase, and this is interesting, is seasonality. The right-hand chart, volatility happens more in October than any other month. These are 1% changes in the S&P by month since 1950, and we can see the significant number of days that October has had with 1% changes as opposed to other months. I don't have any rational explanation for this. Sometimes markets are self-fulfilling prophecies, but it is a fact that volatility typically spikes in October. International valuations have become more reasonable as the market has fallen off. And domestic valuations, based on a forward PE concept, are back to normal levels. There are some other measures where it might look expensive, but on your basic forward PE measure, they are reasonable again. So what are we watching? Now, this chart is very busy. We're watching corporate earnings, and this tells us in the right-hand chart, the right-hand side, both earnings and revenue for the third quarter for what companies are reporting. And it's something that we follow. I'm not going to go into detail with it here, but it's by sector and whether they're meeting or not meeting expectations. But I wanted to call your attention to the donut on the right-hand side with the gray and the orange, and the large gray part of the circle and the small orange part. That represents the percentage of companies that have currently reported in the third quarter, so earnings are just coming in. Right now, they look good. but it's still too early to make a call. But it is something we're watching very closely, and strong positive earnings could certainly change this downward momentum that the market is experiencing now. We're also looking at corporate debt. Corporate debt to GDP ratio is high, and we're looking to see whether it heads higher. This is a little bit misleading in the sense that the interest coverage for corporations is pretty good because profitability is good and rates are low. So even though companies are significantly indebted, their actual interest payments as a percentage of their profits doesn't look terrible. But many of the companies, especially the junkier companies, have floating rate debt. So this is also something that's very important to look at. And finally, wage inflation. Unemployment is so low, we're looking at whether inflation is tame or not. Wages often are a very important indicator of where inflation is going. And finally, we follow very closely the leading economic indicators. I am not going to go into that. I am going to turn this over to James, who is going to tell us about the leading economic indicators.
Thank you, Howard. My favorite topic of study, particularly as it relates to forecasting recessions and forecasting the markets as an investor. So the first thing I'm going to go through is I'm going to go a little bit over the history of the leading economic indicators, and then we'll look more into the components of each of the indicators themselves, and then discuss their utility. So this data series is originally developed post-war out of the National Bureau of Economic Research under the supervision of Dr. Jeffrey Moore. He's the founder of these indicators. But what they were looking for are indications that from data series that might give them an information on whether or not a recession might be forthcoming, a recession might be occurring, or a recession might have happened. And so they grouped them into 3 categories. And the ones they came up with, these 10, are ones that tend to turn over and get worse before a recession even occurs. The National Bureau of Economic Research has passed on the torch. They're no longer putting together the LEI. It is put together now by a group called the Conference Board, which describes themselves as a global independent business membership and research association working in the public interest. They're a 501c3. And their own description of the leading economic indicator is the composite economic indexes are the key elements in an analytics system designed to signal peaks and troughs in the business cycle. The leading index is a composite average of several individual leading indicators. They constructed to summarize and reveal common turning point patterns in the economic data in a clear and more convincing manner than any individual component, primarily because they smooth out the volatility of the individual components. So the sum is greater than the part. So here are the 10 components of the leading index, and I'll go through them individually here in just a second. So this slide, this is the leading index all the way back to 1959. The gray bars represent recessions, and I'll draw your eye to a couple of patterns here. The leading index has turned over before each of the gray bars. It has turned over before every recession we've had since 1959. It also is a little bit more sensitive than the economic cycle itself. It has turned over a couple times, or a few times, and we have not had a recession. There's typically been some intervening fiscal or policy stimulus that pushed the economic cycle further along, and so that a recession did not occur. But generally, when the momentum in the economy slows down, this indicator rolls over, we get ourselves into a recession. So the first component we'll look at here is the weekly hours of production in manufacturing. And what I'll highlight is where we're standing today. In weekly hours of production in manufacturing, we're sitting at 42 hours. So the average worker, non-supervisory worker in the manufacturing segment is working more hours than they have at any point in this cycle. And actually at any point since we've had, since World War II, which is all the way here on the left-hand side. You can see all the overtime everyone was putting in the war effort. And so the fact that these workers are working so many hours leads us to believe that they're working much harder to try to fulfill orders, and that is good for forecasting our future economic growth. In that a lot of orders leads to a lot of work, which leads to further workers and further employment. which is also borne out by this series, which is the average weekly initial claims for unemployment insurance. These are people that are being laid off and filing for unemployment insurance. Draw your eye to the lower right-hand side. We are at levels that we haven't seen since the late 60s. Very few people are being laid off at this time. The labor market is very tight. I actually saw a headline go by today. Alan Greenspan was commenting that this is the tightest labor market he's ever observed, which is borne out by this. There's just no one being laid off at this point. And to keep in context, this is just the aggregate number of layoffs. Our population has increased significantly over this span of time. This is manufacturing new orders for consumer goods. So this is just tallying up the total orders for consumer goods. And you can see we had obviously there was a recession back in 2008 and 2009. We recovered from that. We had a bit of a slowdown in the late 2015, early 16 time period, and we've been rallying ever since. And they are just about to break out to new highs. Another measure of slack in the economy, or lack thereof, is the ISM vendor performance, suppliers delivery. And what you're looking for here is a high level. A high level means that deliveries are slowing down because suppliers can't get their product to their customers fast enough. And when it falls below that 50 line, what we're looking at is faster deliveries, meaning that suppliers are able to get their orders out to their customers, which suggests that there will be slack in the system and that orders are drying up. So this is a good sign for forward economic progress here. Then we get over to capital goods. Now this is not consumer goods. These are non-defense capital goods. So this is basically capital equipment that you would expect a corporation to buy for itself, and deepening its manufacturing capacity, office capacity, you name it. You can see those orders have picked up quite a bit. A lot of the explanation of the dip that we saw back in 2015 and 16 with the low oil prices, when oil went from $100 a barrel down to 25 bucks a barrel, oil has come back, but the entire economy has accelerated over that period of time as well. And we do expect to see further CapEx, meaning capital spending by corporations over the next few years. Part of the tax bill was 100% accelerated depreciation for corporations, meaning if a company spends money on its own capital stock, they can fully write off that expense in the year they spend it, so long as they have the profits to cover it. So we expect a lot of capital spending plans to be accelerated over that 5-year window. And we're about 1 year into it. Think about how capital spending works and the budgeting process in any given corporation is, you know what the rule is. You do your planning, you do your budgeting, you find your vendors, you put in your order, you receive your order, then you book it. So there's a long lag time between knowing you want to spend the money and actually spending the money. And we think we're just starting to see the fruits of that tweak in the tax code. This is another interesting component here. This is the building permits for new private housing units, also known as housing starts. And you can see the general trend over time. Again, these are just aggregate numbers, not adjusted for inflation or anything else. And you can see we had a nice housing bubble post the dot-com bubble, and then we had the housing crash, and now we've had some growth in the housing industry. And the big wild card, and I think this is of particular concern right now, is that the increase in the 30-year mortgage rates will hurt the new housing market. And there's also a contrary line of thought that the existing home sales or existing home listings might actually decline from here, as those people with low rate mortgages essentially are locked in, because if they sell their house and buy a new house and get a new mortgage, they'd have to get a much higher interest rate. So the supply on the existing home side might actually contract, while the new home builders will actually have pricing power in that they have less competition. But this is something that we're going to watch very closely. If interest rates are really going to impact the economy, this is likely the first thing that we're going to see in this data series, in the LEI itself, is going to be this housing starts. And so if housing starts start to roll over, that might be a great leading indicator that this cycle might be coming to an end, and that interest rates are the cause of that. Stock prices. So this is the Ulster 5000 price index. You can throw in the S&P 500. The idea is the same. Investors, when they're flush with capital, bid up stock prices. And when they're not flush with capital, if times are tight, times are tough, or they foresee tight times coming, they will sell their stocks. Well, you can see the market is relatively near its all-time high. We're just a few weeks off of our all-time high, to be honest. And it remains to be seen if this is actually, if this cycle's over. I mean, in terms of the market highs that we've seen. But so far, this is a positive indication. I mean, we're still up year to date. Here's the leading credit index. Now, this replaces M2 in 2012. So M2 was the money supply, which prior to the 80s was a pretty good indication that consumers had money to spend, and it's literally just the savings in bank accounts and other money time deposits. That relationship broke down throughout the 80s and 90s with the advent of consumer credit. And so the consumer or the conference board replaced M2, the money supply, with what they call as the leading credit index. And what this is measuring is stress in the credit system. And it's most acutely seen here in this 2008-2009 period during the financial crisis. Credit stress, meaning credit spreads, the rates that lenders require over and above the treasury bond or the risk-free rate otherwise. And also LIBOR rates, what banks are charging one another. When those go up, money is tight, and there's lots of fear essentially being built into that market, and expectation by the credit market that conditions are going to get worse. You can see on the lower right-hand side here that credit conditions are actually pretty good right now. Credit spreads are very tight. LIBOR is basically trading at near Fed funds. We don't have a lot of stress in the credit system, which leads us to believe that lenders will likely continue to lend, and the economy will probably keep ticking along. Here we get to interest rate spread, and this is essentially, this is the slope of the yield curve. The way you would read this chart is if it's below this black horizontal bar, the yield curve is inverted, meaning that the Fed funds rate is higher than the 10-year yield. And there's a couple of explanations for why a negative or an inverted yield curve is a bad thing. One is that the Fed is fighting inflation, and their main mechanism of action is raising the Fed funds rate. And if they're raising the Fed funds rate aggressively, they get up and over what the natural market is buying out there in the 10-year and beyond, or 1 year and beyond, in the bond land, those rates are being set by market actors and not by the Fed. And if they're willing to accept a lower interest rate than the Fed is demanding, it likely indicates that the economic activity in the future is going to decline. Also, having an inverted yield curve disincents banks from lending, as they have to pay more on their deposits relative to what they can get on a fixed rate loan out at any term. As you can see right now, the yield curve has flattened, but it is not inverted. This condition can hold for some period of time. And you can see in the mid-90s here that the yield curve was flat for a very long time before it finally inverted significantly, and we did get the 2001 recession. But this is one of the most reliable indicators that exist. Basically, every time the yield curve inverts, we're getting a recession. This index is the Conference Board Consumer Confidence Index, and this is literally just them going out, the Conference Board going out and calling individuals and asking how they feel about their economic prospects in the future. And when confidence is high, generally the stock market's high, they're more likely to consume and spend. Confidence is high when people expect to get a raise, when they expect to get a bonus, and when they expect to spend more money. And you can see right now, consumer confidence is essentially as high as is about the highest that we've seen it since the late 90s, which is great. And that corresponds with the unemployment rate that we're seeing. We have a 3.7% unemployment rate in the United States. And so your average consumer out there is actually quite bullish on their own prospects because of the tight labor market. So the LEI is great at forecasting recessions. It's done a very admirable job of forecasting all the recessions that we've had. But as an investor, what is its utility? So what this chart is trying to get at is using the LEI as a signal to reduce equity market exposure. And what you see, the vertical lines there correspond to points in time where the LEI has rolled over or gone negative over a 6-month period. So the preceding 6 months are either flat or negative. And you can see there where that has occurred. Following each of those declines beneath zero, you'll see that the market also sells off for a protracted period of time. And so not only does it call it a recession, but it basically calls the bulk and the majority of the bear market that follows. Now, it's not perfect. What I've got on this page is a big grid here, but on the lower portion of the grid, what you'll see are these are market crashes or significant market declines in the modern era that were not preceded by the LEI turning over. And most of them are the result of foreign activity, things that just aren't going to be imputed into the natural economic growth. The euro crisis, oil prices declining, the currency crisis in 1998, and even the 87 crash, which was a psychological blow. What I will draw your attention to, though, is that the magnitude of the decline of recession-driven bear markets is greater than those of a short-term correction or a market panic, like you see in the bottom portion there. So recession-led bear markets have averaged a downturn of about 31.75% relative to the declines of the panics of about 20%. The duration of that decline, how long the market continues to go lower and lower and lower, you'll see is over a year on the recession-led bear markets and much shorter for the shorter panics. And the recovery time is also significantly longer in that it takes 3 years or so to recover from a recession-led bear market. This is from the top of the market to the bottom of the market and all the way back to the prior high level. And you can see it's only about 1 year to recover from your, those examples of market crashes there, unrelated to recessions. And so what the LEI allows us to do is forecast the economic cycle. It allows us to know where we are in the economic cycle in general, and maybe gives us some heads up on when to start contracting the quantity, the proportions of stocks that we own in our client portfolios, and maybe even reducing them if we do see a recession forthcoming. And that gives us, basically will help us cover what could be a long protracted downturn. And then also identify on the upside when the indicators start getting better, when to get back into the market. But it's not a perfect indicator by any means. But it is highly, highly useful in forecasting the economic cycle. And right now, it looks pretty good. So thanks for taking the time to me talk about the LEI.
Thank you, James. We hope you found this useful. If you have any questions, please contact your relationship manager or your portfolio manager. They'll be glad to help you with them. We look forward to seeing you next quarter. Thank you for your time.